So we've had some movement from the Bank of England, and now the governor's come out and said, well, they feel quite confident that we may see a drop in interest rates. So let's talk about that. We'll also talk about some of the deals that we've been doing for first-time buyers, next-time buyers. We talk about limited company buy-to-let transactions. We're talking about people that are actually moving assets from personal names into limited companies, some of the things they should watch out for. High loan-to-value mortgages, whether you're going for a 2-year fixed, 5-year fixed, essentially specialist type of deals like right to buy council houses, foreign nationals with visas. What else we got? We talk about special properties if you're buying near commercial entities and shops and flats that are above shops essentially. So there's a lot out there. I'll leave it all in a table in the description, so you can just click on the various topics that you're interested in and it will skip you to there. As always, like and subscribe. This channel's been running now for a couple of years. We've got over 12,500 people that have subscribed. So if you're somebody that watches these from time to time, just click the bell icons and also subscribe, and I'll catch you there on the video. Hello everybody, it's Pam here from Niche. It's been a very long time. I think I haven't recorded a long tail sort of video for about a month. I did manage to record some short sort of lives when I was in the States visiting. But yeah, it's been a while. We've been busy writing business, and I haven't had time essentially to record some of these videos. But I thought it was a good timing to record one of these because there's been some movement in regards to predictions around interest rates. We've had the Bank of England governor come out with some positive news around interest rates, whereby he believes that it's likely that interest rates will start decreasing. The consensus really at the moment is that interest rates are going to come down by a little bit around the August time. So they'll start decreasing. Now, where they're going to end up is interesting, because although we've had all of this sort of positive news, lenders' rates have actually been repricing, so and upwards. So in the last 2 months, I would say many lenders have repriced their product 3 or 4 times, believe it or not. I've seen some lenders reprice twice in a week up. Okay, not down. Everybody thought interest rates would come down, and there are a couple of reasons for that. The main reason is around inflation. The Bank of England believes obviously the inflation rates are around about 3.2, 3.3 right now. So they're waiting for that to come down. Obviously, we've got the troubles in the Middle East, and that's affecting global sort of inflation. But the biggest indicator, and I've said this many a times, I don't believe that our government has much of a say, or in terms of our Bank of England has much of a say. I believe it's all down to the US. And the US market's very interesting because inflation is very still quite relatively high there. And they haven't adjusted mortgage rates. So mortgage rates, actual mortgage rates, are actually gone up over the last month or two in the US. So and that's having a big impact. And I honestly don't believe that the UK, the Bank of England, are going to make a move by themselves without the US doing so. And I think they will follow the US. Now, you have got a couple of things with the US, which is political. You've got the elections potentially coming up. And I think for the Democrats to go in to an election without an interest rate cut, it will be a big issue. So I think even if it's a token interest rate cut, you may see one. And I think the Bank of England will follow suit with a token interest rate cut, 0.25%, and I think they'll probably hold it out for a couple of more months. So I don't think it's going to start tumbling down. I think they'll do a token interest rate cut, you know, probably with a little bit of pressure from our Conservative Party, because we're going to go into an election, so the Chancellor can turn around and say, do you know what, we've turned things around, you just got to give us a little bit more time and we'll get things on the track. So I think fundamentals, you know, when you look at the money market, you look at the banking crisis, certainly in the commercial sector, those problems are still there. You see the problems with the Middle East. You see, you know, going into winter, what's going to happen. We've still got the Russian war going on, and I still think none of those things have been solved. You know, none of the issues that we had, the fundamental issues that we had, say, a year ago, have been dealt with. So why are they cutting in interest rates? So I think you know, I myself, I've just done a remortgage of a buy-to-let property, and I took out a mortgage deal, and I did it about 5 months ago. And I think the same deal is about 30 basis points higher than the mortgage offer that I got I think about 5 months ago. So that just shows that rates have actually been creeping up. I did a 2-year fix first, certainly for a buy-to-let, but not many people can, because then you need to make the rental calculations work. So a lot of the people that we're having conversation with at the moment, they're tending to go for a 2-year fix and hoping that interest rates will stabilize. But there is a big difference between a 5-year fix and a 2-year fix in terms of rates. Okay, the lenders are actually giving out cheaper rates on a 5-year fix. Also, which I personally don't agree with, we've seen a number of high profile lenders running affordability. They give you essentially more if you opt for a 5-year fix. I don't think that's actually the right thing to do. I think that's incentivizing somebody to be potentially locked in at a higher rate, maybe in 3 or 4 years time. And I don't think that's the way lenders should be doing things. But I am just a broker. I'm certainly not a bank. So let's talk about some of the things that's been happening with the market in terms of the buy-to-let sector. Fees are still high. The product's choice is there. There's a lot of movement. Personally, I'm seeing a lot of movement on buy-to-let, and in regards to things like specialist finance, bridging finance, people buying properties, doing them up, selling them, converting them. I'm doing a number at the moment where clients are buying a property, splitting it into 2 essentially, and then splitting the leases. We're doing that via bridging finance. Either the exit is going to be a sale, or they're going to refinance. So we've seen those. We've seen ground up developments. We're seeing a lot of landlords moving their personal properties into limited companies, and that's a big sector. Now, one point on that, everybody just looks at the rates. Oh yeah, what rate can you do on a limited company compared to a personal mortgage? Oh yeah, but the limited company rates are much higher. It's not just about the rate. When you're doing something like that, when you're starting to move some properties from one entity, which is you, to a limited company, another entity, other factors come into effect. The first place you need to be speaking to is a tax advisor, not an accountant, a tax advisor in regards to property. The reason for that is when you're moving an asset, an investment asset, into a limited company, there are taxes you've got to think about. Capital gains tax. If you bought it for 100k and now it's worth 500, what are you going to do about capital gains tax? What are you going to do about stamp duty? Did you know you have to pay stamp duty? You're transferring it from one person, you're essentially selling it. And when we do a mortgage, you're selling that that property to a limited company. Granted, there's a gifted equity involved in it, or a director's loan, where you're not putting physical money in there, but you're actually selling it. So taxation is really important. Also, how are you going to take that money out? Okay, so dividends tax. You need to understand how you're going to get that rental money out. Okay, your own tax position. Where are you sitting right now? Are you a low rate taxpayer or a higher taxpayer? Where do you see yourself in 5 years time? All of those things are important. So it's nonsense to talk about rates and fees until you are clear on your strategy. Okay, no point talking to me because I'm just going to talk to you about mortgages, right? You need to go and speak to a specialist tax advisor to understand the vehicle and how you're going to be evolving as a business if you're going to go limited company, because that will impact your lender choice. Are you going to have other shareholders? How are you going to set up the company? Is it a company that you're going to set up for 15 quid? Well, I don't recommend it. I think a professional should be setting up your company, for example, to make it more flexible for the future, how you deal with the shares, how you deal with assets, allocations, what you're going to do about inheritance, all of those things, taxation going forward, not just going into it. So limited company stuff. But I'm also seeing people that are selling their residential properties to a limited company and then purchasing another residential property. So essentially they're offloading that asset to a limited company, maybe because they're high rate taxpayers, or for whatever reason they're selling it to their limited companies, and then they're moving on and purchasing another one. So it used to be called the let to buy scenario. You used to do it, used to rent your existing property out and buy another one. Now you're doing that, you're renting the property out, but also at the simultaneously you're capital raising, you're pulling some money out, and also you're going to sell it to a limited company. So those sort of transactions happening. A lot of movement on visas. Okay, so a lot of people, foreign nationals living and working here. We've been in this market for 16 odd years. I've been specializing within this sector. I'm seeing a lot more lenders with choice around loan to values, higher loan to values, 5% deposit, 10% deposit. There are lots of different conditions. I see a lot of clients that have tried to do the deals themselves. They approach the main lenders, read the forums, and they screw it up. So we've seen a lot of that. Right to buy is a big sector for us, and we're doing a lot of council homes purchases, a lot of council homes where families are purchasing together because mother and father are too old to get a mortgage. The son or the daughter goes onto the mortgage, and we can work the affordability based on their income and their age. So that's a big sector. A lot of people buying together in total. So 4 people applications, working on 4 people's incomes. That's a good one. And I'm also seeing a lot of adverse cases. Now, because of the cost of living prices, we're seeing a lot of adverse issues. Now, this could be as simple as missing mobile phone payments because you've changed contracts and you didn't keep up with the old contract, or it's moved on halfway through. Parking fines, that's a big one at the moment. County court judgments for parking fines. So there are some lenders that will ignore that if it's under £300, for example, and you've paid it off. So there's a lot of issues around adverse credit. Now, it could be more serious stuff. Missed mortgage payments is probably the ultimate more serious stuff, and that's still very tricky because the lender would say, why would I want to lend the money to someone who's proven that they haven't paid the existing lender off, or they've had problems in the past, in the last year and the last 2 years, paying their mortgage off? Do I really want to deal with someone like that? So there's a lot of they're nervous around that, and specialist advice needs to be sought on all of this stuff because it is quite specialist. Affordability, we've seen more and more lenders tweak their affordability because they can't do much on rates. Their affordability calculations are tweaking. So I'll give an example. There's been more lenders in terms of first-time buyers. They'll give you more, potentially go up to 5.5 times income. There is a particular lender at the moment where only one of you needs to be a first-time buyer, and they'll give you a first-time buyer calculation for both of you. Okay, so if one of you, husband and wife, has owned a property in the past, husband's a first-time buyer, they'll give you that additional first-time buyer affordability. So a lot of movement around affordability on the higher stuff. On the lower stuff, if you're earning a lower amount, I've seen them being penalized. People are being penalized quite heavily. So the old notion of 4.5 times income, 5 times income, that goes way out of the window. In fact, I ran an affordability with a building society. It was a specialist case. I think they only gave me 2.8 times income, okay, because the client's income profiles were not there. Obviously, taking into commitments is a big issue. So there's a lot of movement. A lot of people at the moment are considering the 2-year and 5-year or a tracker deal with a no early repayment charge. So there is a broad range of a need out there, and I'm a big advocate. I would be, because I'm a broker, in terms of getting professional advice around this. A lot of declines we're seeing for various reasons around job changes, for example, lenders not believing certain jobs that are happening, big hikes in income sometimes that have a problem, and 0-hour contractor and fixed term contractors. Okay, so there's an issue with fixed term contractors. So you've been working for a company and then you go and become a contractor on a fixed term basis. A lot of the lenders have got rules around, or mainstream lenders, what I would say, they want to see an experience of 12 months contracting. That's really important. Now, there are some lenders that you could tweak it and say, well, it's industry experience. They were in HR for 5 years working for an entity, and now they're in HR, but they're on a fixed term contract. So there are some lenders that could have a look at that. Umbrella companies, again, there are certain criteria around umbrella companies, daily rate contractors. So there's a lot more movement around daily rate contractors, the norm being whatever your daily rate is times 5 times 46. That's the going rule for affordability. Again, they've got various rules around how long you've been in a contract, how long you have left on the contract. So the key bit is everybody's different. Every single person has got a different rule. gifted deposits. How does that work? Is it from the UK? Is it from direct family members? Is it from friends? Is it a loan? How does that be dealt with? So, and as people struggle in terms of affordability, and everybody struggles, you know, the person who's on £150,000 to the person that's on £30,000, they both struggle for affordability. They could be because that person's got, I don't know, school fees, nursery fees, you know, kids, you know, all of those things have an impact on lending affordability. And we as brokers, what we're trying to do is help clients go through the maze of working out not only who's best for the affordability, but the rate, by the criteria, by the property. Property type is another major one. I get probably a couple of inquiries a day where a lender or the clients have approached a lender directly or via what I would say is a standard broker in terms of a fees-free broker. I don't have to pay us anything, but you don't get anything. What you've got is they've not experienced enough and they're sending out valuers or doing valuations via lenders with properties that are near commercial facility, for example, next door to a pub, next door to an industrial estate, opposite a fish and chip shop, or opposite an entity, an off license, above an off license, and that next door to a hair salon. All of those things, they're not standard. Okay, so what happens is, one, most standard lenders will not do them. Two, if they do them, and if you have to go specialist, you might have to take a haircut on the loan to value. So they would say, yes, we can lend up to 90% loan to value, but if it's, you know, above a takeaway, we'll only lend that 60% loan to value. And that will impact the sale price, that will impact your saleability. And that's why a lot of lenders will say, look, we don't want to do it. If it's a buy to let, does somebody want to rent above a chip shop, for example? We think that's going to have an impact on the rental values or the property values. So a lot of lenders will not lend on them. So this is the stuff that we've been doing. I hope everybody is well. I will try to make a video, maybe a video a week now. Now I'm back. Now I'm in the groove again. Let me know what you guys have been up to, and let me know if you want any topic, anything that I've touched on, if you want me to do a greater sort of level of detail video on it, or if you've got any questions in regards to mortgages, please feel free to leave a comment, and I'll catch you in the next one. Take care. The content of this video does not constitute giving advice. It's purely for information purposes. All cases should be discussed with a professional mortgage broker. As a mortgage is secured against your home or property, it could be repossessed if you do not keep up mortgage payments. Niche advice is authorized and regulated by the Financial Conduct Authority.